So good afternoon, evening, morning, ladies and gentlemen, depending on where you're joining from. I am Tuhin Chaturvedi. I am a tax partner with RSM Kuwait. Thank you very much for attending RSM's Pillar 2 seminar for Kuwait. The global minimum tax is one of the most significant developments in the international tax arena. And in the GCC, Bahrain has already issued its Pillar 2 legislation, and Kuwait may issue its Pillar 2 legislation soon. Our distinguished speakers today are Rachael Atkins, PhD, who is a senior manager in RSM's Toronto, Canada office, and one of RSM's Pillar 2 leads in North America, and Sarah Hall, FCA, who is a tax partner in RSM's London office and RSM UK's national lead for specialist tax accounting and reporting services. Please input your questions in the chat box and we will answer as many of them live as time permits. And without further ado, I will now hand you over to Rachael and Sarah. Next slide, please.
Thank you, and good afternoon, everybody, or evening or morning, depending on where you are. It's afternoon for me and very early morning for Rachel. So thank you all for joining us today, and we're looking forward to talking to you today in this session. You had an introduction of us. So just if we just go on to what we're hoping that this session will fulfill. So first of all, we're hoping that we'll put Pillar 2 and its key requirements into context for all of you. We'll help you understand the practical challenges that we're seeing in the clients that we're working with at the moment around Pillar 2, and explain how businesses are currently preparing for its implementation and the reporting which is going to be required, which as we go through, you will see is quite extensive. So to break that down a bit more, we'll go through the background and context of how Pillar 2 rules came about. We'll do an overview of the rules for you. We'll then move on to the key considerations and challenges you should be looking at, and then a focus on the transitional safe harbours, which are very helpful to reduce the reporting requirements, at least for the first 3 years. And then finally, we'll talk to you about how RSM can help and the sorts of areas that we're seeing clients working on at the moment. So I'll hand over to Rachel just for the background and context.
Yeah, Rachel, I believe you're mute. Hello.
Yes.
Thank you very much. It is very early on this side of the world, so it's always good to switch our microphone on. So thank you very much for everyone joining us. So Sarah said I'm joining from Canada, so it is very early doors for me today. But I'm all switched on now. So just thought it'd be worth us sharing a bit of background and context as to where Pillar 2 came from. And where we are in the journey now. So it started off in 2015 with the BEPS Action 1 project. So this was really looking at addressing tax challenges of the digital economy and how we've moved from being bricks and mortar in a location to a much more digital world. And in 2019, they proposed this two-pillar solution. You may have heard of Pillar 1, which is very much looking at the digital aspect of it and making sure profits are sitting in the right jurisdictions. And then we had Pillar 2, which is this global minimum tax. So this two-pillar solution was introduced. In 2021, there was a general global consensus that this two-pillar solution was the right direction to go. And actually, this is where we really saw the draft model rules come out at the end of 2021. Then in 2022, we had the implementation package for Pillar 2 published, and we started to see countries sign on to this. We had a few early adopters. The UK was one, some of the other European countries, and actually we also saw it in Asia. But then actually in 2023, this is when the first taxing rights came into force. So Sarah will touch on this a bit more about how the rules are, but we've started to see countries implement from 31st of December 2023. And then finally, we're in 24, and this is where some of the other taxing rights will come into play. Sorry that I can just hear someone talking. If everyone could just make sure that they're on mute for this webinar, that would be fantastic. Thank you. Okay, so yeah, so now we're in 2024. So we're seeing countries that have implemented from 31st of December 23 or 1 January. And we have the final taxing right that is going to come into play at the end of 2024. So, Sarah, I'll hand back over you to give us an overview of what Pillar 2 is.
Thank you, Rachel. Yes, so what exactly is Pillar 2? So it applies to multinational groups, so you need to be in more than one jurisdiction, where you have consolidated revenue of 750 million euros or more in 2 out of the 4 previous periods to the year that you're looking at. First applies to accounting periods starting on or after December 31st, 2023. So as Rachel just said, we are now starting to see the first year being December 24 that groups are having to think about the rules. And you have to have at least one jurisdiction within your group that is adopting the Pillar 2 rules. Essentially, it imposes a global minimum tax of 15% across your group, and that minimum rate has to be met in each jurisdiction that is within the rules. Any shortfall below the 15% gives rise to what is known as the top-up tax payable, and then that will be collected in either by the ultimate parent entity, or where the ultimate parent is not within a Pillar 2 jurisdiction, it will be collected at an intermediate parent entity, or locally through a domestic minimum tax, or by another entity in the group through the undertax profit rule. The effective tax rate is calculated per jurisdiction and for the overall group, and where that falls less than 15% in any jurisdiction, you have a top-up tax payable. We are seeing that rather than it being a cash tax implication for most groups, it is actually more an extensive reporting challenge, and you will see as we go through the amount of data that is required to be gathered, and that's not just from your accounting data and your tax data, it extends to payroll, tangible assets, etc. Thankfully, we do have some transitional safe harbour rules which apply in the first 3 years, which means that there is significantly simplified reporting for those jurisdictions where they're met, and we'll come on to those a little bit later. So just thought it's worth explaining the key terms if you decide to pick up the Pillar 2 rules and have a read. First, we have the ultimate parent entity. That will be the very top company in your group at the highest point at which you consolidate and produce consolidated financial statements. They will normally have primary responsibility for making the global return and looking after the top-up tax. However, where that entity is not in a jurisdiction applying the rules, such as Kuwait currently or the US, you then go down the group until you find an intermediate parent entity which is within the rules. So that may be, for example, US-owned business followed by UK subsidiary. They would be the intermediate parent entity. And then they are the ones that are responsible for the top-up tax collection and reporting. All other entities that are in the group are known as constituent entities, and they do include permanent establishments. So if you have a branch in France, for example, that will be resident in France for Pillar 2 purposes. So that would create a French jurisdiction for you as part of the group. Go back to Rachel on the taxing rights.
Perfect. So if we think about how Pillar 2 actually works in practicality, there are these 3 main taxing rights that apply. So Sarah touched on them earlier when she was talking through how this tax gets collected. But there are 3 different ways that this tax can be collected, and it will come down to a jurisdiction by jurisdiction basis as to whether they only adopt 1 or all 3 taxing rights. Generally, we are seeing all three being adopted. However, we are seeing in some situations where only one or two are being adopted at this point in time. So the main one that probably is being adopted against most jurisdictions is the qualifying domestic minimum tax. And what this is it's implemented at a local jurisdictional level, but it has to be implemented in line with the Pillar 2 rules. So to be qualifying, it has to make sure that it's following what the Pillar 2 model framework is doing. This is the most common one that's being implemented, where perhaps in some jurisdictions the income inclusion rule and the under tax profit rule is not being implemented. And this is because this actually gives the local jurisdiction the right to collect the tax under these qualifying rules. It's fully credible against the other two taxing rights, so the income inclusion rule and the under tax profit rule. However, again, back to this point, it has to be qualifying in order to achieve that credibility. As part of the Pillar 2 rule mechanisms, safe harbors have to be available for these qualifying domestic minimum taxes. So again, if a country has one, then there's a safe harbor available for that. There are some variances from the safe harbor rules. So Sarah mentioned earlier around the substance-based carve-out. That's not necessarily a requirement. So again, these need to be looked at in detail, but again, it has to stay within that framework. And more very importantly, this is again more geared to some of the US taxation system, where they have similar principles that are in play to Pillar 2, but not quite the same. So for those who've been familiar with the US taxation, we have GILTI and US Subpart F. This is not limited to that. It's also to any other CFC regimes that any countries have. Under the Pillar 2 rules, there is the ability to allocate taxes that are being paid in other jurisdictions to a local income. However, you can't do that under the qualifying domestic minimum tax rules. It only looks at the tax that is being paid locally, and then any top-up tax that then therein would be paid. Then we have the income inclusion rule. So this is the primary or one of the key taxing rights. So in this situation, this gives a parent entity the ability to tax its foreign subsidiaries. So obviously this has to be in place. So for example, from a US perspective or from a Kuwaiti perspective, at this point in time, these rules are not in play. So the ultimate parent would not be able to tax its foreign subsidiaries. So then, as Sarah said earlier, we would look down the group and say, for example, we have a UK intermediate parent, then the IIR would be applied at the UK level because UK has implemented, and then that would apply to its subsidiaries, foreign subsidiaries underneath. If there is no qualifying domestic minimum tax, then in that situation, the UK would be looking to apply and collect that 15% tax. Finally, we have an under tax profit rule, and this is coming into force from December 31st, 2024, and this is really a backstop. So this would be in a situation where, again, we have a US group or US parent. It's got no intermediate parents that are in a Pillar 2 jurisdiction, but it might have a subsidiary that's in a Pillar 2 jurisdiction. Then this essentially allows any other group and any other subsidiary in the group to apply taxing rights to those those entities that aren't caught by either a qualifying domestic minimum tax or the income inclusion rule. So just to visualize what this kind of looks like, because it's a lot of words and lots of different taxing rights. So as we said, the qualifying domestic minimum tax would apply first. So in this group structure, so again, we could have a Kuwaiti group here, and this is an entity that sits in the UK. Then actually, because UK is implemented, they would get the first taxing rights on this in this situation. Then in examples 2 and 3, we're just essentially looking at whether or not the ultimate parent or the intermediate parent would capture it. But again, the same principles apply, which is if this was a UK company where IIR would apply, then again, it would apply this to all of its subsidiaries underneath. But if in this situation, in number 3, the UPE is actually a US parent or a Kuwaiti parent at this point in time, because they haven't adopted, then we would look down the group and say, okay, here's the intermediate parent where these rules would apply. And then finally, in the fourth example here with the UTPR, if this was all Kuwaiti, and then we had again this UK entity, then actually the UK entity would be the one in green, would actually collect the tax on the low tax jurisdiction. So they'd be sister companies, but the UK company or whichever Pillar 2 company, whichever companies in a Pillar 2 jurisdiction would have that right to tax the low taxed entity. There's one more rule that is coming under Pillar 2, although it's not part of the calculation per se, but it is factored into how much tax is being paid. And this is the subject to tax rule. So this is a treaty-based rule. This is very much looking at intercompany payments and levying withholding tax on certain intercompany payments. It's being administered by a multilateral instrument that all the countries are going to sign up to. So it is going to have to be addressed in addition to local tax treaties that are already in play. There's a prescribed list of what these certain payments are. So it really looks at royalties, interests, management fees, most intercompany transactions, I will say, are caught by this, with the exception of a few ones that would fall under more trading aspects. It is restricted between tax treaties between what is defined as a developing and a developed economy. There is a specific definition looking at from a World Bank perspective, but what it's aiming to allow is for those developing economies to implement a 9% withholding tax in a situation where perhaps the treaty does not allow that at this point in time. So again, you wouldn't expect to see this to say between US and Canada, for example, because they're both developed economies. It's really to target those developing and developed economies. So that definition does need to be looked at when thinking about structuring intercompany payments, and it is something that will be factored into the Pillar 2 calculation.
Speaking of, so thanks, Rachael. So how do we calculate a top-up tax? So first of all, it's really important to understand your group. There are lots of definitions around excluded entities, intermediate entities, various other categorizations. So it's important to have a good knowledge of your group and where they are all sitting, particularly things like branches. Where are they going to be situated for Pillar 2 purposes? Once you know where your entities are, you split them up per jurisdiction. And then you calculate what is known as the globe income. So that's the profits of that jurisdiction and adjusted for certain areas as discovered in the rules. Once you've got the globe income for each of those entities at jurisdiction, you move on to covered taxes. That starts with your total tax charge per your financial statements. So we are looking at tax accounting and reporting numbers here. We are not looking at what goes on a tax return, although of course that helps determine what that is. You take that, you make certain adjustments to it, such as on deferred tax on losses brought forward, for example, and various others, and you get to your covered taxes. You add all of the covered taxes up per jurisdiction, divide that by your total globe income in that same jurisdiction, and arrive at your effective tax rate. Where that effective tax rate is over 15%, you stop there, nothing more to do. Where it's under 15%, you then have a potential top-up tax payable. In our high-level example here, we calculated an ETR 10%, so that means we have top-up tax to pay of 5%. How the actual tax liability is then calculated is you take your globe income. From that, you take what's known as the substance-based carve-out, which is a certain percentage of your payroll and tangible assets. That starts at a higher percentage, but is reducing down each year that we are into the rules, for ending up at 5% by 2032. You calculate that, take that away from your globe income to arrive at your excess profit, and it's to that amount that you apply the top-up tax percentage, which was the 5%, arriving at top-up tax of 4%. So just to bring that to life a little bit more, this is an example here where our ultimate parent entity in country A is not within the Pillar 2 rules. So we are looking down at our constituent entities 1 and 2 in country B and C. So if we take entity 2 first, which is the easiest one, we have globe income of 1,000, covered taxes of 250, which gives us an effective tax rate in that jurisdiction of 25%, comfortably above the 15. There's nothing more for us to do there. When we look at country B, we have globe income of 2,000 and only 100 taxes paid. That means we have a low effective tax rate in that jurisdiction of only 5%, meaning our top-up tax percentage is 10. Then we need to work out how much is actually payable. We take our globe income of the 2,000, take off our substance-based carve-out, which is calculated here as 5% of our tangible assets and payroll being 500, so we get to the 25. Take that from your globe income of 2,000, apply the top-up tax rate that we calculated earlier of 10%, and we get to top-up tax of 198. So how is all of this reported? So as we said earlier, there is, in our experience so far, there are not too many groups where this is causing a huge cash tax issue. It's actually more around the data collection and the reporting of it. It's a monumental exercise. The Globe return has at least 180 data points that could be relevant to any group. And you can have potentially multiple filings across your world. So it's definitely worth getting a handle on this as early as you can. Each group will have to submit what's called the Globe Information Return. This will usually be submitted by the parent entity, but it can need to be submitted by all entities within the group. It just depends if there are an information exchange agreement between each jurisdiction who can access the Globe return at the wherever it's been filed centrally. Otherwise, each Pillar 2 country will have to file a return. They will also have to file local Pillar 2 returns in each jurisdiction as well. And rather unhelpfully, the ones we've seen so far, the data is slightly different for the local Pillar 2 return as it would be for that country's data in the Globe return. So it's a bit of a double data collection there. Within the Globe return, it has an overview of all constituent entities within your group, the tax identification number, where they're tax resident, which is important to establish, for example, where you have a branch, their status under the Globe rules. You'll need to submit a complete organisation chart, all data and information that is used to compute the effective tax rate in each jurisdiction and any resulting top-up tax, and also a record of any elections that you opt to make to the rules. Can I just ask everyone to make sure they're on mute, please? Thank you. Ultimately, the Globe return will be due for filing 15 months after your period end to which it relates to. However, in the first year, that's extended to 18 months. So the first returns we're looking at are in relation to 31st December 2024. So they will be due by 30th of June 2026. So we do have some time, thankfully, although as you will see, it's a huge undertaking. So the earlier that you can get to grips with where your data is coming from, the better. To make it a smoother process. Rachel.
Thanks, Sarah. One of the areas that we have really established as we start to work with businesses on this is we start off with, this is a 15% tax problem. Are we paying tax in each jurisdiction? And how can we make sure that we're in the right position? However, as we've been working through this with businesses, we really started to understand that this is not just a tax problem, but actually this is really transpired into being a whole organizational problem and needs to be addressed not by tax, but actually there are multiple different factions within an organization that will need to feed into these calculations. So as Sarah had mentioned earlier, it is primarily a reporting challenge. The Globe rules have significant administrative burden, as Sarah has already talked through. And actually, even though you may not have any actual tax liability, so we're seeing a lot of businesses that actually, when they come out at the end of either in safe harbors or actually even if they are doing a full calculation, there is no additional tax liability. All of this reporting has to still be done. All of these returns have to still be filed, and all of this still has to be addressed. What's very different about Pillar 2 from a tax perspective particularly is we are very focused on the group. So traditional tax looks at, whilst there are aspects of a group you have to understand, we do very much look at entities and we look at jurisdictions and we look at how rules apply locally. And whilst Pillar 2 has elements of that, we do very much have to understand how the group is structured, because that's going to dictate how the taxing rights apply. So again, if we go back to thinking about these examples, we can have a sister company somewhere in a group that is actually applying a tax to a company that is in a completely different jurisdiction. In some situations, depending on how the consolidated financial statements are prepared, or even if there are any prepared, because we focus very much on GAAP for the purposes of how the group is structured, even if locally there's no requirement to file financial statements, there still may be a group under Pillar 2. So again, it's very important to understand what that group looks like and how the rules apply. Data is a huge area of focus. We are now taking, as Sarah said, we're now taking information, tax information and accounting information from 6 or 7 different locations. So all these numbers exist, but they're now being taken and put into a whole new set of numbers to calculate a whole new tax return to determine if there's any new additional tax under this new regime. So Pillar 2 is essentially a whole new taxation regime that has been introduced. This is where a lot of businesses are really spending a lot of their time really understanding where that data is coming from, how it can be gathered, because there is on estimates. I think the latest count was about 400 data points that need to be gathered, and that's per entity, per jurisdiction, that has to be aggregated in order to do these calculations. So again, a very big change as to how traditionally some tax elements may be working. Because there's a financial disclosure aspect to this, and because this is not just going to be a tax return that's going to file in a local jurisdiction, but actually globally, tax authorities are going to see the tax position of a group. It's very important that governance and internal controls are being addressed, particularly if there's a listed entity or you're operating in a sector that is very regulated. So again, making sure the accuracy, reliability, and efficiency of this compliance is actually being addressed, but also just in terms of managing stakeholders. So auditors are now asking a lot of questions, board members are asking questions. But it's not just limited to that. It's also your external advisors. So again, engaging with your external advisors to help you with this, understanding what the requirements are, of course, using them to understand what the requirements are. But there has to be a collaboration between both the company and the advisors in order to achieve the correct endpoint. But then very helpfully, what we're seeing is these rules are very much a rule in progress. So model rules were released in December 2021. But actually, we have seen, I think, is it 5 iterations of admin guidance that have come out that have changed those rules. We are seeing countries that have early adopted consistently update their legislation for any changes that have come out. We're expecting more administrative guidance, but we're also expecting more countries to come online. So I think to date, there's about 40 countries that have adopted or near adoption. There's 140 countries that have signed up to the inclusive framework, and we're going to see a whole host of new countries coming along. Of course, Kuwait is one of those. So this is very much rules are a work in progress. Things are changing, monthly, and it's constantly being practiced. So it's something that needs to be monitored in order to keep up. To touch a little bit more on the data process, so we're going to look at the qualified CBCR aspects of it, but although that reduces compliance for the first couple of years, once we're out of those safe harbors, then we're into the full reporting. Or it could be that your jurisdiction does actually not. Some of the jurisdictions don't actually meet the safe harbor, so you're straight in. So there's really 3 areas around this that we're thinking about. So again, there's the data sources. So where is this data coming from? Is it HR? Is it finance? Is it tax? Is it actually, the real estate team with it internally? There's a lot of different areas that this information is coming from. So it's starting with that, understanding how it's going to flow through. Then we have the calculations. So these calculations, they're very complex. Their software will be required to do these calculations, and the reason for that is because all of the local jurisdictions are adopting their own local aspects of these calculations. A lot of the software solutions that are coming out, they're looking at calculating both locally from the parent perspective, and of course the under tax profit side. So these are all working in conjunction with each other, and then have to figure out then which takes priority. So the calculations themselves are not as complex. It's actually how the taxing rights apply and how all of this information flows through and how the specific jurisdiction rules apply. So that's a real key part of this, and understanding about how you're going to report it and how you're going to calculate it. And then finally, we have the reporting and filing. So there's the Global Information Return, as Sarah talked through, but there's also all the country specific forms and the filings. Again, as Sarah spoke through, we're starting to see each jurisdiction adopt their own aspect to how this is all going to be done. But in addition to that, there's the reconciliations that need to be done. So going back to the financial statements, having an audit trail, and that's not just for the purpose of tax. Of course, if a tax authority inquires into it, you need that audit trail, but actually also for the purpose of any audits that are undergoing, so that when the auditors come in and look at it, they have that understanding of how these numbers have been reached. And then, of course, there's the disclosures that are required in financial statements, depending on what financial reporting you're doing under. So certainly IFRS have put a whole host of information about what disclosures need to go into the financials. US GAAP have done the same thing. But we're also seeing local GAAP. So in the Pillar 2 rules, there is a list of what is accepted GAAP for the purpose of Pillar 2. So it's really important, again, to understand who fits into that and whether that fits within what you're reporting under. But then also there's the monitoring and the tracking. So as I mentioned, there's a lot of countries coming online. But even once they come online, what we're also seeing is that some of the filing requirements in jurisdictions are not the same as the Global Information Return. So the payments, the local filings, and any other kind of notification are varying from that Global Information Return. That is fixed. That's either 18 months or 15 months after the year end, depending on what year you enter into Pillar 2. But then everything else is down to a local jurisdictional level. So there is a monitoring and tracking required from that perspective. We have a timeline here just to demonstrate. It's for a typical calendar year end. So of course, these timelines would all be shifted if you're not a calendar year end, but actually you're more of a fiscal year end. But I think really importantly, what it shows is that, okay, yes, at this point in time, we're about 18 months away from that first filing deadline. That is not that far, given all of the things that have to be thought about between now and then. But actually, once we then get into that full reporting, there's only 9 months between the first and the second return. And then therein, it will be 12 months after that. So actually, in terms of when we start to think about what that cycle is going to look like, how that implementation and the time that you have to do it, it's really important to keep those filing deadlines in mind, because actually they will creep up very quickly once we're into the Pillar 2 reporting.
Just to add there, Rachel, is on
Yep.
the notifications and registrations. So Belgium had surprised us all with an early notification that needed to be made earlier this year in July or September, depending on your situation. The UK has to register for Pillar 2 6 months after the first year end to which it applies to, and so it's again worth keeping an eye on that for all jurisdictions that you have in your group, and including that on your filing tracker.
Yes, exactly. I think one of the things that's worth touching on as well, again, this will depend on whether a company is a UPE or a company in Kuwait is the UPE, or actually they're a subsidiary and of a large multinational. But this is not just a head office issue, and the reason for that is because, again, of the breadth of data that is required across the group. So we are seeing, and we'll talk through some examples in a little bit, but there are in some situations where actually the way that head office is working is they're giving the responsibility to they're going from a bottom-up approach. So they're actually giving responsibilities to the teams that overlook, for example, EMEA, APAC, LATAM, and such. So this is not just a case of whilst the UPE has that sole responsibility to file and compile and make sure that's all in there, we're seeing groups want to work within the different subgroups, or, you know, even maybe divisions within their group, in order to actually start to gather this information and comply with the local rules. And part of that is because there may be very large subsidiaries or very large subgroups out underneath the UPE that actually operate almost individually to some extent, because that's how their group works. So it's very important to understand that whilst the ultimate responsibility in the group view is with the head office and the ultimate parent entity, there is a part to play for both large and small subsidiaries within that group, and therefore this is something that needs to be kept in mind depending on, you know, what your role is within the company. We touched briefly on stakeholder engagement earlier, but again, this is something to keep in mind. So who is tax and finance going to have to engage with? And this is going to come down. I say tax and finance because we see it varyingly across business as to who owns this product line. Some are tax, some are finance, some it's joint. But again, it's just thinking and understanding what this would look like, and starting to educate those interested parties, and start to educate those stakeholders. You know, what is Pillar 2? What are they going to need to expect if something is required of them, and when is that going to have to happen? So we talked briefly again, some of the local finance teams may be required to feed into this. There's tax and finance leadership, so they may be the ones that are owning this, or in fact, they may not be owning it, but the tax team is and has to feed up to tax and finance. Reporting processes are really important because, again, we're going to be putting in a new reporting process for the purposes of Pillar 2. So this is going to be alongside any like financial reporting, any existing tax reporting. Now we have a Pillar 2 reporting requirement. So this is going to be very important to feed into that, because information that feeds into Pillar 2 is going to come from other existing reporting processes. We talked about briefly audit committee and the auditors. So what do they expect? What are they expecting to see? When are they going to need that to get comfortable around Pillar 2? Shareholders, this will go for both privately owned companies, but of course, publicly owned companies. Shareholders are going to want to understand what this impact is on them. We've seen under IFRS, they've actually asked, even though Pillar 2 wasn't in play, it was asked to disclose any sort of material aspects around it. US GAAP is only as and when the legislation is implemented. So we're now starting to see companies disclose it in their quarterly reporting from a US perspective. But again, these are all really important aspects that have to be factored in, that again, we're not just filing a tax return. There are other aspects that have to be thought about. And then, of course, our tax authorities, you know, what are they going to want to see? What are we going to have to file? But what are we going to have to be able to keep in order to be comfortable from a tax audit perspective, to make sure that, you know, we are complying. I think one of the things that we have talked about is, what do businesses really need to think about from a budgeting perspective? So there are 4 key areas that need to be considered. People. So this is a whole new taxation regime. This is not people's day job. This is my day job. This is Sarah's day job. But this is not the general business day job, because depending again what the role is, you know, you might be more of a finance tax. Pillar 2 is a whole new layer that has been added on into people's roles. So it's important to understand, do you have people in play around sufficient resource? So to handle this, but do they have the knowledge to implement and execute the Pillar 2 reporting process? But also, do they have the knowledge to maintain it? And so at this point in time, is that something that, you know, the business can handle? Does it need to be considered in conjunction with advisors? You know, and that could be with the idea that someone eventually takes it on once they have that knowledge. But this is there is a lot of nuances with Pillar 2 that need to be addressed. Data and systems. So again, it's thinking about, where is that data coming from? How are we going to deal with it? Who owns the data? But also, how robust is that data? It's estimated between 40 and 60% of the data that is required is not in an ERP system. So this is not going to be a case of, oh, we'll just download our GLs, or we'll download our P&L, we'll give it to our tax advisor, and our tax advisor is just going to run it through the Pillar 2 software. the data is a lot more intricate than that, and actually requires multiple different sources and departments that have to come from this. So it's just thinking about when we're thinking from budgeting. And I think it's important that budgeting doesn't just mean, oh, I'm going to have to pay my tax advisors more, I'm going to have to pay my auditors more. It's about an internal budget around time and resource and but also of course monetary, because if you need to hire new people or you need to implement new system or anything like that, that requires planning from that aspect. So these are important aspects to think, not just from a monetary, but also from a time perspective, how this is going to get dealt with. We touched on governance and processes earlier. So again, that factors into that budgeting point around thinking of what are internal controls like? Do we need to do any work around them to kind of increase that robustness and really bring that transparency and audit support? And then finally, technology and automation. Most businesses are looking at a technology solution for this. And I don't necessarily, again, mean it's a one-stop button. There is the software element, but that software has to be implemented and adjusted for that business, because the software has to be manipulated to make sure that it's suitable for the group that is implementing it. And this will be looking at things like the group structure, making sure that the entities are correctly identified, making sure that the ownership structure is correct, but also making sure that the taxing rights are being applied in the right jurisdiction. But it's not just the software, it's actually gathering that information as well. So there are certain data points within Pillar 2 that actually you probably can take just from your GL. So it's about understanding about what can be automated, what can be pulled on an annual basis very easily by the group versus what needs more data manipulation, and how can we make sure it's put into the format that's correct. So this is where a lot of businesses that have started on their Pillar 2 journey are starting now to look at, to see how they can use technology to enhance their reporting to do that. But then, that then does come on to what are your external costs? So again, we come back to audits, financial disclosures, country by country filings. Now I am aware that Kuwait at this point doesn't have a country by country reporting requirement, but where a Kuwaiti business is part of a multinational group that falls into Pillar 2, there will be jurisdictions that will require this country by country filing. Sarah's going to talk more in a minute around the transitional safe harbors and the importance of country by country filing now, where we've gone from informational to this now has an impact. But again, these are one of the things that have to be thought about. Local tax reportings and filings. So again, it's not just global information return done. What do we have to do locally, when and how? Tax provisioning is a huge part of this now. Our numbers that we start with for the purpose of calculating the effective tax rate are what is recorded in the financial statements. So that is your currents and your deferreds, as Sarah said. So now that focus on tax provisioning has come to a new level, because that is actually going to dictate how much tax you may or may not have to pay. And then finally, just anything Pillar 2 related. So as you're implementing, doing any impact modeling, implementing a design, looking at automation, or just, doing reporting support, whatever model that you choose, that's going to be a cost to you. But the reason why these all have to be thought about is because there are risks involved from Pillar 2 because of the complexity and because of the level of intricacy, but also the scrutiny now that is being looked at by both tax authorities, auditors, shareholders, but also actually from the general public. Because, this is a big thing now, multinationals are being expected to pay 15% in each jurisdiction they're in. And this is going to be something that has to be disclosed publicly if you're a public company, in terms of from a financial disclosure aspect. So it's really looking at those risks externally, but also internally. As a tax professional that owns the Pillar 2, or a finance professional that owns the Pillar 2 service line, of course, we don't want to have an unexpected tax liability that perhaps wasn't anticipated because the initial stages of work weren't addressed. If there is any tax impact from an effective tax rate and a cash flow perspective, then obviously that wants to be addressed up front. But ultimately, there is a reputational risk. Tax is a very heavy, focused area from a general public perspective. So again, it's just making sure from a reputational perspective that everything is being done to put in place to make sure there's a limited risk from that side. Okay, back over to you, Sarah. Oh, we can't hear you. I think something has happened to your microphone.
Sarah, please adjust your microphone. I can't hear you. Can you hear me?
We can, yeah, I can hear you. I think it's I'll carry on while Sarah's just fixing her microphone. So the OECD, as part of the Pillar 2 rules, they've introduced the transitional CBCR safe harbors. And the idea of the transitional CBCR safe harbors is to simplify reporting for the first couple of years. Oh, shall we give that a go?
Does that work now?
Yes, perfect.
Okay, good, excellent. Back online. Sorry about that, everybody. New laptop, so obviously it's not a great one. Right, so thanks. Yeah, so this is the transitional CBCR safe harbors, and as Rachel said earlier, you don't currently have country by country reporting within Kuwait, but likely will do across the multinational group because it has similar limits applies to Pillar 2. So these apply for periods starting no later than 31st December 2026, ending no later than 30th of June 2028. And you only need to meet one of the 3 tests that we have there, and we'll go through those shortly. It only applies if a qualifying CBCR is used, which is interesting because, as Rachel alluded to earlier, CBCR up till now has just been very much an informational gathering exercise, and as long as you were consistent with your approach, it was generally accepted, and there was very little guidance. However, in December 23, extra guidance was issued by the OECD as to what qualifying is, and we'll come on to that shortly. You look at the results again per jurisdiction and see whether you meet the safe harbour tests per jurisdiction. And where you do, it means that you don't have to do the full reporting initially, and it is still some reporting to do because we can't get away from that at all, but significantly less. So it reduces that burden on businesses now, which is really important and gives you that little bit of extra lead time to get up to speed with the full reporting. So if we go through the 3 CBCR safe harbours, the first one is the routine profits test. And this is using the same substance-based carve-out calculation that we spoke about earlier, and where your profit or loss before tax is equal or less than that substance-based carve-out, then you meet the test there. It also applied this de minimis test, which is where you have revenue from your CBCR data of less than 10 million euros, or profit less than 1 million or a loss. And the one that we're seeing most businesses apply, and actually is where we're doing most of our work, is the simplified ETR test. It's around this that the clients are being asked by their auditors to have a really robust process around this. You need to show that you are based on qualified data and how you're getting that information, and that you can meet these simplified ETR tests. And sorry, Rachel, can you?
Sorry,
A bit excited there. In order to satisfy the auditors and give them sufficient evidence that there is no top-up tax to pay, and more importantly, no detailed reporting. So the simplified ETR test is taken from your CBCR data. So again, this is why it's very important to make sure tax provisioning is robust. You take the current tax expense from there, you add to that your deferred tax expense, and then you take off the uncertain tax positions for the year. You collate that for all entities in that jurisdiction, divide that by your CBCR profit before taxes, and to arrive at your simplified ETR. In 23 and 24, that rate is 15%. So where you're above 15%, you meet the test. That rises to 16% in 2025 and 17% in 2026. So gets a little harder to pass that test. I would say that this is another key focus for your tax provisioning. Unlike once you're in full reporting, this simplified ETR test is taking the data straight from your CBCR. So if, for example, you had deferred tax losses brought forward that you're bringing on balance sheet for the first time, that could create a large tax credit in the current year, which could unintentionally bring you down below your 15% simplified tax rate. Once you are in full reporting, there is one of the adjustments to covered taxes is to remove the impact of any brought forward losses, but that does not apply when you're looking at the safe harbours. So it is very, very important to think about when you're recognising deferred tax assets or anything else that may cause you to have a current tax credit unexpectedly. Can move on now. Thank you. So what is qualifying CBCR data? So as I said, we have had a bit more guidance issued. You do have to apply it per jurisdiction. So certainly in the UK, we are in current discussions with HMRC about what they consider to be qualified CBCR data. So it'd be worth checking that in each of the jurisdiction that your group may be situated in. What they have said is that it has to be based on qualifying financial statements. And now that could be either the consolidated financial statements of your ultimate parent entity or the separate financial statements for each constituent entity, provided they are prepared under an accepted GAAP. Where you have a non-consolidated entity, because it's just too small, it then has to be in line with the parent company GAAP. It needs to be consistent. You can't change year on year. It needs to come from qualified financial statements in the same financial statement basis in each jurisdiction. And where you have different sources, again, you'll be disqualified from the safe harbours. Similarly, if you're making any post-year-end adjustments, such as transfer pricing from the qualified financial statements, again, you cannot apply the safe harbours using the CBCR data. Finally, we have one last safe harbour, which is the UTPR. So this helps you, particularly where you have a parent company in a jurisdiction that is not adopting Pillar 2, such as Kuwait at present or the US. And this applies for tax years ending before the 31st of December and gives you some relief for the first 2 years from full reporting. It applies where the ultimate parent entity has a statutory corporate income tax rate of at least 20% in their jurisdiction. It means that that entity will not be subject to the under-tax profit rule for the first 2 years that Pillar 2 applies. You do have a choice which safe harbour you apply if they're all applicable, but for all of them there is the once out, always out approach. So for example, if we go back to looking at our ETR and the importance of making sure you don't have that big credit going through, if in year one you pass that safe harbour comfortably, that's great, you're in simplified reporting for that jurisdiction. If you look at it again in year 2 and you've suddenly recognised a big deferred tax asset and you have a large tax credit going through and you're out and you don't meet any of the other safe harbours, you are out permanently and straight into full reporting. You can't then reconsider it again in year 3. So again, as we said earlier, that's really, really important to look at where you have UPEs in a parent jurisdiction, not in Pillar 2.
Perfect. So I think we'll just wrap up the webinar with just talking about how we've been helping businesses, but also how we can support businesses in terms of looking at Pillar 2. So we spent a long time thinking about what this might look like and how this goes. And really one of the key aspects, given the complexity and the challenges that Pillar 2 proposes, there's really a need for a practical approach to deal with these challenges. So our model is broken down into 4 key phases. And it really is a series of questions. So 1, what does Pillar 2 mean for our business? This is initial assessment. And this is looking at the CBCR safe harbours. This is looking at the group, understanding where the risk points may be, understanding where there's any potential liabilities, and then doing a modelling as well for the purpose of these top-up tax liabilities. This is really important where, again, we're looking at companies that have gone into Pillar 2 rules. They have to make financial disclosures. They need to give auditors supporting information. We've been helping a lot of businesses in this space to kind of really address those initial aspects. Then the second one is, what do we tell our stakeholders? So this is really where we start to look at, well, we are here today. We've done an assessment. We understand these are our risk points. How are we going to get to reporting this, and how are we going to communicate this to our stakeholders? So this is really looking at the people aspect, the processes, where that data is coming from, mapping that data, understanding how that's going to be reported, who's going to actually feed into that reporting process. So again, looking at that, is it a top-down, bottom-up process? All those different aspects, and really laying out a roadmap to get to from where you are today to where you need to be to file that first return. Once that roadmap is laid out, then it's really saying, well, how do we enable a reporting process? So this is the implementation side. So this is implementing software. This would be looking at, putting all the processes in place. Then, of course, we get to the annual compliance. And whilst that is technically a phase in itself, I would say it's a 3.5 phase, because of course it is required that at the end of all of these reporting processes is the compliance aspect, but then there's also the final sort of process enhancement, because how do we continue to monitor and optimize for changes, because as we talked about, we're constantly seeing changing legislation, we're constantly seeing countries come online, but actually it's not even just limited to that. It's if you're expanding into new jurisdiction, or you're selling a company, or you're buying companies, or any sort of group aspects that you are doing, will impact Pillar 2. I think we've coined in the Pillar 2 world, it's ultimately now whatever you do locally, all roads are leading to your Pillar 2 return, and how that's going to impact. So it's really important to keep that in mind. Some of the aspects actually, sorry, I will talk through that already. What I will talk through is just giving some real life examples, just in the context of time, of how we've actually helped clients in this space. So again, looking at this risk and review. So in this situation, it was a UK finance team that was a large subsidiary of a US parented group, and it was present in 20 jurisdictions. In this situation, the UK was actually the IPE. So it was taking the lead for the European subgroup. So essentially you had US and US's group, and then you had the UK, which was parent of the European group. So they were taking that lead, but then as they very quickly realized that, you can't just exclude the US because the US hasn't adopted, it has to be looked at a group structure. So we helped them understand what the risk of top-up tax was in Europe, because of course that's where the initial top-up taxes were going to be implemented either by an IIR or a QDMTT. That's going to change for 24, because now we'll have it under the UTPR, 25, because now we'll have the UTPR. So those European groups, companies will be able to tax the US in the situation that the US isn't paying 15%. And by the sounds of what's happened in the latest local after the local election and the discussion of reducing the tax rate to 15%, there could be a very high chance of that. Then we also help from an impact modeling focus in those territories as well. So again, it was just understanding, what that would look like. But actually, it then evolved from, as I said, you can't just focus on European, you have to look at the whole group. So it was looking at that broader impact from a Pillar 2 aspect. And what this helped them understand was, again, enabling a clear understanding of likely tax and reporting areas, setting out this practical stage approach. So, it's not a case of one stop and done. It's not a big ticket exercise. It's going to be done in phases, because things are changing, different aspects are coming online. Are you in safe harbors? Are you not? Do you only have some, not others? So it's a real kind of phased approach that has to be looked at. But then also, as we've talked about stakeholders and such, it allowed the subsidiary team to really understand their role in this and the wider group. And so just to kind of end on, that's how we've been helping clients, just in terms of next steps. So, this Pillar 2 is a very unique challenge. We have a network here. So Sarah and I, as I said, this is our day job. We're working very closely with our Kuwaiti colleagues, but we are dealing with multinational businesses across the network. So if this is something you're interested in having that kind of conversation, then of course, we're available to do that. I'm going to hand back over to just to summarize this all up.
Thank you, Sarah. Thank you, Rachel, for an insightful presentation. And for the lack of time, there's only one question I can read that. if any one of you can take it, if the global income is a loss, will it be carried forward? How it will be treated under Pillar 2? Can you answer that?
Yeah, I'm happy to take that, Sarah. So yeah, there are rules around what we do with globe losses. What I will say is the rules are very complex. So it's not, they don't exist as perhaps a loss mechanism might exist under an existing corporate income tax regime, where you make a loss one year, you carry it forward, you offset against profits the next year. In context, there is a mechanism that allows that, but it's a lot more complex than that. And that's because of how it all interacts within determining the effective tax rate and how it interacts with the covered taxes. So yes, there is an ability around some of these globe losses to kind of carry them forward, but the complexity of how it actually applies requires a bit more consideration around that.
You might say that it may be subject to local domestic laws. Am I right?
It will be subject to the local domestic laws in terms of from a qualifying domestic minimum tax. It will be subject to the ultimate parents laws when you're looking at how an IIR applies. It will be subject to the local domestic minimum laws depending on how the UTPR applies. But then it will be subject to how it looks like within the jurisdiction and the group. So again, you could be in a situation that one company's making a loss, one company's making income, and we're amalgamating all of that. So the rules are very complex because we don't look on an entity by entity basis. But I think the key thing is that, yes, there is mechanisms in there, but it's on a very fact basis as to how the rules would apply.
It depends on the jurisdiction to jurisdiction.
Yes,
that's
right. Exactly.
Okay. And I think the time is up, and I would like to thank all the participants. And because of the lack of time, we will not be able to answer some of the questions. But please do write to us in the board. We'll respond back to you. Thank you all. Thank you. Thank you all.
Everyone.
Bye-bye.
Thank you. Bye-bye.
Bye-bye.